When nothing happened and everything shifted, at first, it felt like a false alarm. No breakdown, no surge, just a stretch of time where the market refused to react the way everyone expected it to. This story matters now because markets don't always change through violence. Sometimes they change through silence. When reactions disappear, when signals lose power, and when participation thins without explanation, the system is already moving into a new phase. To understand how a major shift began without price confirming it, we need to revisit the period when nothing happened and why that mattered. The absence of movement is easy to dismiss. It asks nothing of participants. It produces no losses to explain, no gains to celebrate, no event to anchor retrospective understanding. Yet that absence, sustained long enough, is one of the most informative states a market can occupy. It signals that belief has been quietly withdrawn and that the system is operating on the last reserves of momentum it no longer trusts. It unfolded during conditions that should have produced movement. Data arrived strong. Expectations were clear. Positioning was prepared. And yet, the market absorbed information without expression. Gains stalled. Losses failed to extend. Everything balanced itself out unnaturally fast. The first reveal appeared in follow-through. Moves started but couldn't continue. Breakouts failed without resistance. Pullbacks stopped without demand. The market wasn't indecisive, it was indifferent. And indifference in markets is rarely neutral. Participants adjusted instinctively. They shortened holding periods, reduced exposure sooner, entered trades expecting exits, not extensions. No one announced a shift in strategy, but behavior was changing across the system. Inside institutions, decision-making slowed. Conviction was replaced by caution. Capital stayed mobile instead of committed. Risk wasn't avoided. It was postponed. The market still offered opportunity, but only briefly and at a cost. The most unsettling signal was the absence of urgency. In prior cycles, hesitation created opportunity. This time, hesitation created more hesitation. Buyers waited. Sellers waited. Everyone waited for someone else to move first. Nothing happened, and that was a warning. Because when markets stop reacting to information, it means belief is being reassessed, not challenged loudly, reconsidered quietly. The system wasn't breaking. It was detaching. And once detachment sets in, the shift that follows doesn't need a catalyst. It only needs patience to run out. As the stillness continued, it began to reveal its true cost. Trades that once offered clean follow-through now required constant management. Gains evaporated quickly. Losses lingered just long enough to feel uncomfortable. The market punished conviction without rewarding caution. The reveal deepened when volatility compressed unnaturally. Price ranges narrowed, but not because of balance, because of withdrawal. Liquidity was present only in short bursts, then disappeared. Movement existed, but it lacked commitment. The early conflict emerged as strategies failed silently. Trend-following models stalled. Mean reversion trades lost edge. Options priced for movement decayed relentlessly. The market wasn't hostile. It was uncooperative. It refused to reward any single approach consistently. Institutions felt the pressure first. Performance slipped without explanation. Risk-adjusted returns deteriorated. Committees debated whether conditions were temporary or structural. No one had proof, but behavior kept pointing in the same direction. Capital began rotating under the surface, not dramatically, steadily, away from momentum and toward flexibility, away from exposure and toward optionality. Cash levels rose quietly. Hedging increased, not because of fear, but because conviction was gone. The most dangerous shift was psychological. Participants stopped expecting clarity. They stopped trusting signals. Every move felt suspect. And when belief disappears, reaction replaces intention. The market hadn't chosen a direction yet, but it had chosen to stop, revealing one. And that choice matters more than any headline. Because when nothing happens for long enough, pressure doesn't disappear. It builds, silently, waiting for the moment when patience finally breaks. The pressure eventually demanded release, not through panic, but through imbalance. A small catalyst arrived, ordinary, explainable, forgettable on its own. But in a market conditioned by stillness, it landed differently. The conflict intensified as reactions appeared faster than conviction. Sellers moved first, not because of fear, but because waiting no longer felt safe. Buyers hesitated, unsure whether this move deserved response or retreat. The silence that once felt stable now felt dangerous. Liquidity thinned abruptly. Not everywhere, just where it mattered. Prices slipped through levels that had held for weeks. Stops triggered quietly. Algorithms responded faster than discretion. The market didn't fall hard. It slid. Volatility expanded unevenly. Moves stretched without momentum, then snapped back without confidence. Traders found themselves wrong-footed, not by direction, but by timing. The market no longer rewarded patience. It punished indecision. Inside institutions, the realization set in. The stillness had been masking fragility. The lack of movement wasn't balance. It was compression, and compression, once released, doesn't need a reason to continue. As selling fed on hesitation, correlation rose. Assets that once behaved independently began moving together. Diversification failed at the exact moment it was needed. The market had synchronized in caution long before it synchronized in fear. This was the critical mistake. Everyone had interpreted nothing happening as safety. But safety doesn't feel this tense. What followed wasn't chaos. It was consequence. The consequence of ignoring silence. Because silence in markets is not empty. It is full of unexpressed decisions waiting to surface. And once they do, the move no longer asks for permission. The climax arrived not as a dramatic breakdown, but as acceptance. The market finally admitted that the period of stillness had ended, and that it had been something else all along. Prices moved decisively, not violently. Liquidity returned selectively, not generously. Participants adjusted without panic, but without illusion. The system reintroduced direction through repricing, not through fear. The resolution unfolded as expectations reset. Risk was redefined. Strategies adapted to a market that no longer rewarded waiting. Optionality became expensive. Conviction returned, but only where behavior justified it. The silence had done its work. In hindsight, the warning had been clear. Nothing happening was not neutrality. It was transition, a phase where belief was being withdrawn quietly before action made it obvious. Modern relevance is constant. Markets still go quiet before they move, still compress before they release, still offer stretches where nothing seems wrong until everything changes. The lesson is not to fear stillness. It is to respect it, because when nothing happens in markets for long enough, something has already decided to change. And by the time movement returns, the choice has already been made. Subscribe to join the journey. The structural significance of this kind of silence is that it exposes a degree to which market function depends on shared belief rather than objective conditions. Markets are not machines that process information mechanically and output correct prices. They are aggregations of human decisions, and those decisions depend on confidence, not only in the information available, but in the willingness of others to act on the same information in the same direction. When that shared confidence is present, information produces movement. When it has been quietly withdrawn, the same information produces nothing. The same data that would have driven a sharp advance during a confident period produces only a shrug during a period of collective detachment. This is why the stretch of nothing was so consequential. It was not documenting the absence of news. It was documenting the absence of shared conviction. And conviction, once lost, cannot be restored simply by the arrival of new information. It requires proof, demonstrated, repeated, experiential proof, that acting on information will produce the expected result. Until that proof has been accumulated, silence continues. And the longer it continues, the more pressure it stores. Every piece of favorable information that arrives and fails to produce movement adds to the weight of unrealized expectation that eventually finds its release all at once. When patience finally expires and the market admits what the silence has been saying all along, when